So let's go through three different methods for calculating depreciation expense. So this is related to all those physical, tangible type of assets. Buildings, machinery, property, plant, equipment, things like that. There are three different methods you can use to calculate depreciation expense. The straight line method, double declining balance method, and sum of years digits method. The straight line method, which we kind of touched on in the last lesson, but we'll go through all three methods with one simple example to make sure you understand it. The straight line method is straightforward. That's basically equal amounts of depreciation expense over the useful life of the asset. So if you have an asset and it's going to hold its value in equal amounts over its useful life and not really decline in value over its useful life, then you would probably want to choose straight line method. On the other hand, if you have an asset like a vehicle, cars, trucks, there are certain kinds of assets that really, they lose their value very quickly. And if you have that kind of situation with the asset, then you would want to probably choose double declining balance method of depreciation, which is basically we're going to double whatever the straight line rate of method of depreciation is to accelerate the write-off of that asset. And then if you have an asset that declines in value somewhat, but holds its value over most of its useful life, this is kind of in between straight line and double declining balance method. So this is a sum of years digit. It kind of falls in between these two methods. So you have to make a decision when you depreciate a tangible physical asset, whatever it is. Will it hold its value? Will it really drop off in value? Or will it kind of hold its value, but it will lose some of its value over time? And that's the kind of decision you have to make when you choose one of these three methods of depreciation. So just let's go through a real simple, I'll keep a real simple example, and I'll use the same example all through these three methods so you can understand how you do this. Straight line method, I think, is pretty straightforward. We kind of touched on it with the building example in the last example, but I'll use another example, maybe a simple example that'll work for all three of these. Let's say we run a taxi cab company, and we go out and we buy a taxi cab vehicle, and we pay $30,000 for this new taxi cab to put into our fleet of vehicles. And we believe that it has a useful life to our business of 5 years. And at the end of 5 years, the taxi cab is kind of wore out, but I do believe I could salvage and sell it and maybe get a little bit of money for it. And I'll kind of keep this simple so the calculations work out easily. So let's just say after 5 years, I think I can go out and get $5,000 for the taxi cab. So this becomes the salvage value. So $30,000 of acquisition costs less $5,000 of salvage value means that what we're going to depreciate, the depreciable basis, is going to be $25,000 under the straight line method. Under the double declining method, by the way, we'll ignore salvage value so we can really accelerate the write-off, and we will take into account salvage value under sum of years digit. So these methods are a little bit different. The salvage value is excluded, it's included here and here. So straight line method, I think, is pretty straightforward. It just means we're going to have equal amounts. So if you have $25,000 and you divide 5 years, right? 5 years, then you have $5,000 of depreciation expense each year. So we will debit depreciation expense and credit accumulated depreciation of $5,000 every year to write off an expense the taxi cab as an asset, a physical asset. So let's take this same example. And let's work through the double declining method and the sum of years digit. Let me move this out of the way. I already kind of have wrote this up a little bit. And these, by the way, this becomes what's called the depreciation schedule. These become depreciation schedules for your assets, and they should be completely documented in a folder. As a controller and an accountant, I would have these to help me just pull off, and it facilitates those closing entries. I knew exactly what my closing entries are per my depreciation schedules for all of my assets. So you would want to set up some type of depreciation schedule for all of your assets that you can refer to in a folder at the end of every month. Under double declining method, if you take 1 over the useful life in years. And in our example, we have a useful life of 5 years, taxi cab. So again, this is the taxi cab example, just so you'll know, we're just following the taxi cab example. 5 years useful life for the taxi cab, 1 over 5, so the straight line rate of depreciation is 20%. If you double 20%, that's 40%. Double the straight line, 40%. If you ignore salvage value, so starting in year 1, what we're going to do is we're going to take $30,000 of acquisition cost times 40%. $30,000 times 40%. Depreciation year 1, $12,000. $30,000 less $12,000 of expense, depreciation expense. So now we're left with $18,000 that we need to write off. $18,000 times 40% is $7,200 in year 2. 18 less 7,200 is 10,800. 10,800 times 40% is 4,320 of depreciation expense. That leaves this depreciable basis of 6,480. One of the things that you have to kind of put down when you use this accelerated methods of depreciation, if you have salvage value involved, as you get close, as you compare this depreciable basis to your salvage value, and as they get close, then what you're going to do is, instead of just, you would not take 6,480 times 40%, because it would give you a very high number that actually would write off the asset below its salvage value. So what we want to do is we want to end up with, remember, we're ignoring salvage value here in our calculation to really write it off. So at the end, we want to make sure there's the salvage value remaining. So 6,480, and we want to leave $5,000. 6,480 less $5,000 is 1,480. So this is the final depreciation expense that we will make to make sure we have $5,000 left over. So this is the double declining method that really writes off the asset really quickly, and you have no entry in the 5th year because you've completely written it off and you've gotten it down to its salvage value by year 4. So this really writes the... So for vehicles, if I were a taxi cab, I would probably say this is the method you would use because it's going to lose its value very quickly right off the showroom floor. If you want to choose something that's in between, then sum of years digit method would be a little bit in between. What you would do is when you set up your depreciation schedule under sum of years digit, you need to take, these are all the digits. Year 1, 2, 3, 4, 5. Sum up all these digits, hence the word sum of years digits. Sum up all the digits that are in your years, 1, 2, 3, 4, 5. If you sum them up, they sum up to 15. So what you will do is you'll take a fraction, 5 years useful life divided by over 15. 5 over 15. If that comes up to 33.3%. You take into account salvage value. So in this example, we'll take 30,000 less 5,000 salvage value, and we're going to literally write off $25,000 in our depreciation schedule according to these percentages, which adds up to 100%. And that's going to leave us with the $5,000. So we just want to write off this $25,000 in kind of not a real accelerated method, but somewhat accelerated, so that we're writing off $25,000 times 33% is 8325. 25 less 8325 is 16,675. This is the amount that, then you take this 1665 times 26.7% is $6,675. This less 1675 less this is 10,000. 10,000 then times this percentage is 5,000. So you just follow it in your depreciation schedule. Set up your depreciation schedule with these rates per these fractions that you come up with, and that becomes your depreciation schedule for under the sum of years digit. So these are the three methods that you would use to expense, depreciate fixed physical assets. The three methods. So pretty straightforward, pretty simple. Once again, I would definitely encourage you to make a decision as to how you write that off and then set it up into a complete depreciation schedule so you can keep track of it and just pull it right off your schedule so you'll know what your depreciation expense amounts are for all the years that you have to do accounting for. So it makes it really easy and quick. And I would also encourage you to look in the case study workbook. I think it's tab 8. There's another example of this, and it has more years. I think it's like 10 years. Go to tab 8 and go through this and make sure you got it down. And that pretty much covers this section. We covered inventory and depreciation of fixed assets. And in the last section of the course, we just want to touch on a few topics that are a little bit advanced, just so that we can kind of put a bow around the course. But this is pretty much getting down to the end of the course, and hopefully you're finding it useful. So we'll continue on with the next section.